We are now recording this session from Talking Hedge Events, Austin 2021. And to lead us off, as I always do, I would like to introduce Meg Bodie, the president and founder of Talking Hedge Events. Meg, over to you.
Perfect. Thank you, Ken. And hello, everyone. We have a very big crowd here today, 20 countries represented, assuming that they call in. This is the third webinar in our spring series, and our spring series is replacing our annual Austin event. We would have been in Austin, and we are sorry we are not there, but hopefully next spring we will make that trip, and we've already been talking to hotels, so that's very, very exciting. I just want to mention before we get started that any of the views expressed by our speakers today are their own. Not necessarily representative of the firms for which they work. So a little bit of Chatham House rules there. What you hear pretty much stays here unless the webinar does get approved to be released later. We have a big topic, diversification, how being different counts. I'd like to thank Teza Capital and some of our other industry supporters, including Inicap and Lixor and InfraHedge and Bodie Research and Crable and Efficient. I have to get my cheat sheet, and Graham and O'Brien Investment Group and Row Asset Management and SLC Management. We appreciate all of your support, and you will be seeing each of these firms at some point in this series. This is, again, our third, and we have 8 planned for you. So we'll be running these on Fridays through the middle of May. I'd also like to thank Emma and Casa and Kaya, our association partners. Very happy and proud to be associated with them. We're going to start today a little bit differently than we normally do. We have a poll. We always have a poll, but we're going to throw it up now. And we're going to let you, audience members, tell us who you are and what you think about some of these topics. And hopefully that will help your speakers understand who's on. And we'll pull the results up just a little bit later. But right now, I would like to ask, I am just delighted to introduce our panel today. I'd like everyone to please turn their cameras on. We have Diane and Derek and Misha and John. And I am going to turn things over to Diane and her panel. And once again, thank you for coming and to be with us today.
Welcome, everybody. We've got a great panel lined up for you today, and I think you're going to really enjoy our discussion on diversification. Let's start by asking the panelists to introduce themselves. And I'll start with Misha. And could you just tell us a bit about your background and your firm?
Sure. Thank you, Diane. Thank you, Meg. Thank you, Ken. Welcome, everybody. Thank you for that opportunity. I'm a founder and CEO of Teza Technologies. Teza started as high-frequency trading shop, and right now we are an asset manager. So presumably everything we do and everything we sort of like worry about and think about is relevant to the audience we have right now. By introduction of myself, I used to be a physicist half of my adult life. I have a PhD in astrophysics from Princeton. Then I worked at Bell Labs, and after that I worked at McKinsey and went to Citadel, where I built Citadel's high-frequency trading operations. And after doing this, started my own company, and that's Teza.
Thank you. And Derek?
Hi, everyone. I'm Derek Drummond from the rainy state of Wisconsin. We are a public pension plan with about $130 billion of assets. We use a little bit of leverage to build a more optimal beta portfolio. So we're about $150 billion. Our team covers anything in the public markets that goes out of house. We run about 60% of our assets internally. So pretty much our mandate is to find diversifying strategies to what we can do internally.
Thank you. And John?
Thanks, Diane. And just to say, I'm based here in Dublin, Ireland, which is, I think, on par with Wisconsin for rain, I would think. So, My name is John Toomey. I'm head of research at Abbey Capital. Abbey is an Irish alternative asset manager. We focus on multi-manager portfolios in the managed futures and macro space. We manage a range of products, including private placement, mutual fund, and bespoke funds of one for large institutional investors. We currently allocate around $5 billion to the CTA space, and we have a full service team of 61 people headquartered here in rainy Dublin. I'm a member of our investment committee, and my team is basically responsible for manager search, portfolio construction, and ongoing monitoring of those managers we've added to our portfolios.
That's great. So we've got representatives from three corners of the industry, which is great. Ken, do we have the results of that poll yet? Right. So in terms of our audience, we've got half the audience is fund managers, and then the balance largely investors and also solutions providers. So that's great. How do you think about portfolio diversification? About a quarter are mainly by asset class. And then just over a third by asset class and taking into account manager style. And then 40%, just over 40%, go deeper, go more granular, which is interesting. I think that will be something we can think about when we're talking later. And then we looked at what type of alternative strategies best provide diversification for portfolios. And discretionary macro is the big one, with over half the people believing that's the best. Trend followers and systematic macro also appear. And there's also relative value, interesting tail hedge strategies, only a quarter of the votes, and adaptive strategies, which I suppose are similar in a way, but they vary. But and then other, which is a little bit there. How well did diversification work in 2020? As expected, which is great. And some people even found it was better than expected. But a few found it didn't work so well. And what keeps you up at night? Low interest rate environment. Inflation at 27%. I would have thought it would be more, actually. So interesting that it's just a quarter. Lack of volatility. Increased asset correlations. Yeah, that's the big one, which is, I think that's something we're going to be talking about as well. And crowding. Yeah, that's another one. And the pandemic, still there. Yeah, a bit worried that might come back to bite us, but hopefully we're moving towards the end game. Thanks very much, Ken. That was great. So let's move on. I thought if we just started with a brief summary of your approach to diversification for each of you. Maybe Derek, as the asset allocator, you should start.
Sure. No, that makes sense. Our approach to diversification, or my approach to diversification, has kind of shifted over the last few years. I used to, when I started my career, the interest rates were much higher 20 years ago, and volatility was higher. You could, my initial construction process was building the managed futures smile, partially using managed futures, but also using other types of strategies. I would own a few things that were long the market, long delta. I would own a bunch of stuff in the middle that was relative value or uncorrelated to the markets. And then I would own some stuff on the left side of the distribution where it was either managed futures, a little bit of tail hedging, but things that did well when long gamma, things that the market sold off. That worked great for a while, but then, after 2008, where you had low interest rates, low volatility, a 10 VIX environment for a long period of time, it was very expensive to own that left side of the distribution. So we moved our portfolio construction, process to more of non-correlation as opposed to negative correlation. And we took some stuff off the right side of the distribution as well. But and that's worked well for the last couple of years. But I do think we're back to an environment where you're going to get some persistent volatility. God forbid, maybe we get a little bit of a higher interest rate environment where you can build a little bit more diversified portfolio. Because I do think that when you buy non-correlation, hopefully that works. But a lot of the things that look like they're not correlated in market environments usually have some kind of conditional volatility, deleveraging risk or whatever, relative value strategies, things like that, credit, and they're not there when you need them. And so I'm hopeful that going forward, we're going to be able to build a much more kind of convex portfolio.
Yeah, interesting. And John, what about you? How do you think about it?
I think from my perspective and from Abby's perspective, it's kind of twofold. So first of all, we think about kind of our portfolio construction, our search for diversification in two ways. First of all, we operate in the managed future space, the macro space, which is, to a lot of people, a very heterogeneous space, right? Or a homogeneous space, right? It's a very similar space. It's trend following, right? That people describe. But our focus is on maximizing the benefit of diversification we can get in that space. And when you start to dig down and dive into it, there's a lot of interesting things going on underneath that hood of kind of managed futures. So our approach is kind of twofold. Firstly, from kind of a strategy perspective, it's to combine the various different return drivers that are out there in the space. So first of all, we take a core of trend following to the majority of our portfolio. It is that classic style. It is that classic return stream and engine that people think about for managed futures. But then we add to that, with our core, a bunch of satellite strategies. So areas where we feel we can add value to the portfolio from different return drivers, things like short-term trading, value type of trading, and even some discretionary macro to complement the trend following. So from our perspective, we think that by really digging into the granular details about these strategies, we can find a way to improve our risk-adjusted returns, improve the diversification benefit, while still capturing that high-level profile that people like that Derek was describing earlier about managed futures. And I suppose ensuring that we don't go too far away from that. At the same time, another key component about the way we think about the world is I think we see ourselves as buyers of risk and allocating out risk to our portfolio. So we try to maintain a constant level of risk, or as close as we possibly can to a consistent level of risk in our portfolio. We try to do that so that we don't end up in that over-diversification problem that certain fund of funds run into at times, which is that, as you add managers, your diversification potentially goes up, but your vol and your potential return goes down. So, one of the benefits of managed futures is you can leverage it. And we do that within our portfolio. And you want to have the risk on, we feel, when the opportunities come. And that's the key thing for diversification and differentiation is if you've turned it off by the time the opportunity comes or you don't have the risk on, it's not going to be there to perform for your portfolio.
We've already had our first question, actually. This is from Stephen Greenblatt. What are John's and Derek's views on long volatility investing? So, John, do you want to carry on and then we can go back to Derek?
Yeah, I suppose from our perspective, long volatility covers a wide spectrum of it. The majority of our exposure is in trend following, which is often considered long volatility. I think that's a bit of a misnomer. I think what trend followers are typically long is directionality, so large moves in the market. What tends to be more, from our perspective, more long volatility in our world is things like short-term trading, where we have, I suppose, more an explicit relationship between the volatility environment and their performance. As assets move more, you're in a position to be able to take advantage of those moves. So typically when we think of our portfolio, and I know a lot of people think about trend following, managed futures as being traditionally long volatility, for me, it's more long directionality. It's long dispersion. It's long those sort of moves in the market. There are other strategies within the managed futures space that may have a stronger relationship to the volatility. Misha might have some thoughts on that in terms of short-term trading and so on, which tends to do quite well, I think, when you get those expansions in volatility.
Yeah, thanks. And Derek, before we go on to Misha, do you want to just pick that up as well?
Yeah, so I want to get to Misha as well because I'm interested in his thoughts. It's been very expensive to be long gamma for the last few years. I do think if you go out the curve, so if we are long volatility, we're looking to be a little bit further out the curve, but you give up some of the gamut, some of the punch in the portfolio. I do think that there are, and I'm interested in Misha's thoughts on this, I do think there are liquidity provision strategies that can be interesting in periods of distress. So that I would kind of term that as long volatility. We break our portfolio into directional and market neutral managers and long volatility and short volatility managers, and you can create the smile that way, and you can figure out who's in what box. I think for guys like us, we are incentivized to be short volatility, especially, we are long deleveraging risk, we're long relative value, we're trying to have a low beta portfolio, but you take on this short volatility. So I love strategies that are long volatility and, market neutral in the majority of the distribution, but actually do well when the markets sell off.
Yeah.
But they're hard to find.
Misha, you've got two questions now. I mean, the one is, what about just continuing the long volatility discussion? And then also, you didn't get a chance to describe your approach to diversification.
Sure. And of course, I represent the other side. So while Derek and John trying to solve diversification from strategic perspective, right? I'm on the side of the manager. I'm almost like have to provide them, a couple of special menu in a couple of special items in Chinese menu, which they would pick for their portfolios if they like that particular thing. So in general, we as managers do not responsible for solving diversification problem. Right? We just need to be different enough or very, very different and create something that is interesting to allocators. So from our perspective, we believe that, and we are working on sort of like both two directions of creating kind of like a super special menu, super special item on Chinese menu. So one is, and it's interesting that the audience said that one of the bigger worry is overcrowding. Mm-hmm. So one direction is actually working on taking advantage of overcrowding. So by doing this, right, we believe that we provide diversification exactly at the right moment that you need it. So if everybody decides to buy Tesla today, right, how do you take advantage of that element? So this is one direction. Can you create a strategy that takes advantage of overcrowding? The second direction that we do, and this is actually coming out from our roots as being a high frequency shop. We believe that everything in the world is dynamic, and the further the world is going, the more dynamic everything gets. So this is ties to the long volatility, short volatility. We trade volatility. We have a special strategy to trade volatility, but it's actually both long and short, and it's dynamically changes from time to time. We also believe that like one of the most important questions for the allocators is stocks and bonds correlated right now or not, right? Because last 70 years, prices were correlated, last 10 years they were anti-correlated, and last 2 years they were all over the place. So the interesting thing here is not to assume that they would be something, but actually react to when they change. And of course, right, like when people say, well, how quickly can you react? And of course, right, like you have to go away from the measurement of daily volatility, and you have to go sort of like very, very, very granular, and you have to react fast. But to like, let's say, at least in John's world, right, like when you trade in futures, when you trade in most liquid products in the entire world, you can actually adjust to change in correlations as opposed to worry about products being correlated. So rather than sort of like worrying, we're trying to take an active approach. And to answer Derek's point about liquidity provision, yes, this is exactly the type of strategies that you kind of seek, right? And I would say liquidity provision doesn't necessarily mean you always put your limit orders in the bid and offer, right? You can cross at the right time as long as your horizon is very, very short. Right. So if your horizon is very, very short, to the long horizon people, you look like liquidity provider because they themselves may be executing passively. Mm-hmm. So I would distinguish liquidity provision from simply putting limit order, like without putting limit orders in the limit order book And then you're absolutely right. Then the beauty of strategy like this, you're supposed to make money most of the time, but when the volatility spikes, you would make a lot of money.
Yeah, that's great. Got another question. This time's for you, Misha. It's from Stephen again, and he says, "What's the best investment lesson you learned about generating alpha?"
Wow. Okay. Probably the fact that, well, that you never know everything. In fact, like you always know very, very little. In fact, as a quant, I would say if you look at any statistics of any signal, right, the probability of being right in my world is always 50 something against 49 something. Right. And then the question is, right, like how do you take advantage of this probability? So in terms of the signals, I would say there are a few things. First, don't assume that everything like stuff will continue forever. Second, typically stuff accelerates. So and the question is, right, like what's the rate of acceleration, right? Like economists call it market efficiency. Right. And of course, right, like, well, we wouldn't be in the business we are in if market was efficient, or at least we believe market is efficient till the last guy who makes it efficient. And that last guy makes money. Right. So yeah, I would say, don't believe you know everything. Signals last forever, don't last forever, and everything accelerates.
Okay, that's great. We've got a couple more questions, actually. So this one is Brennan Basnicki. Even within trend following, there's big dispersion amongst managers, with some of the biggest CTAs being financially tilted and underperforming at critical times. Commodity diversification has many benefits. Has a commodity tilt by asset or manager become more of a focus, or do you anticipate it to be? John, should we start with you, and then perhaps Derek and then Misha?
Happy to do so. This is something which was quite close to our heart in Abbey. We've been, I suppose, a long-term allocator, a strategic allocator to a significant amount of commodity in our portfolio for a long time. When you think about trend following, at the heart of your portfolio, you're searching for diversification, or those managers are searching for diversification. And in fact, the commodity markets by construct are some of the more interesting markets from underlying return drivers. When you think about some of these markets, particularly in the commodity world, just the cost of transport, the cost of carry of them from one place to another creates local dynamics. The best example is, UK natural gas and US natural gas. They behave completely different to each other because of the cost of transport. So I suppose the natural function for us as someone who likes trend following, who likes the space, is to be attracted to that diversification. And from our perspective, we've always structurally had, I would say, a significant overweight in commodities relative to probably what you saw elsewhere. We've targeted within our portfolios. And to be honest with you, it's been difficult. The last few years for trend following in commodities have been quite difficult. I think we've seen the impact of kind of the homogenous global economy, right? Things have been working in unison, in tandem everywhere. And, for the last 10 years, that's been the narrative. You go back 10 years before that, we had, booms in certain countries, busts in others. But we haven't had that for the last while. And that has had an impact on not just financial assets, but also commodity markets. And what we've seen, I suppose, in the last sort of 2 years has been the majority of trend following returns have come from those markets. And when you look at the space, those are the really interesting things that have been moving, whether it be cotton more recently, nickel, before that, with the entire move on the, I suppose, the EV movement, and the entire, green movement will require commodities as well, the move towards ESG. And that next step will require commodities and may inspire another super cycle. I don't know. I'm not sure about that word. But from our perspective, and it comes back a little bit to ensuring you're there and that you have the risk on in these markets, because it's easy to step back from it and say, okay, it hasn't worked for the last sort of 5-10 years. And it comes down to making sure that you understand why it's not working and what Is it in line with your expectations or not, given the environment? But I suppose from our perspective, we feel quite strongly on that side that that's a key part of the diversification profile of managed futures.
Yeah, I would echo everything. I'm trying to think of, we echo a lot of what John just said. So I was trying to think of the next kind of iteration. A couple things. One, when I look at the attribution from some of my highest quality quant managers, the commodity space is usually a very high sharp space for them. And it's sometimes a little counterintuitive because, usually, commodity managers, there's a number of blowups in the commodity space too over the years, right? And you get volatility, you got diversification, you can do directional and relative value trades, you can do crack spreads, all these kinds of things, calendar spreads. Like there's a lot to do in the commodity space too. So I think it's a very rich place for alpha, but you have to have your wits about you too. The only other thing I would say is I agree from the diversification standpoint, only with the exception that as part of exactly what John was saying with this global reflation trade, and I think it's somebody's, one of the question, the answers to the poll was, asset correlations. I do think I do think commodities right now are a little bit more correlated to this reflation trade, to the EV trade, to global coordinated growth. And so as a beta investment, I'm not sure it's as diversifying right now as it has been in the past, but that's, that might be temporal.
Got it. And I want to throw a couple of cents. Obviously, continuing the theme that then John and Derek has much broader problem to solve, and my problem is to provide them with a couple of solutions which would be completely different from what they have on the table. We are looking at we excited about commodities. We actually trade more commodities than we trade equities at that point. But when we approach to that problem, we have different foci than essentially your typical CTA. Because if you come in and you just another CTA, okay, how are you diversified? So for example, that our directional futures program does not more than 85% of the signals actually don't use prices as inputs. So when we look at commodities, right? And this is going back to the crowding, right? We try to look at analyzing of people actions rather than changes in prices, right? And it finally turns out to be that and just a little bit of a technical bit, the covariance matrix of returns is very structured in commodity. Covariance matrix of people's actions is completely unstructured, and it provides you diversification in the much further amount of factors than the return space would provide. The other interesting direction, and we've seen other people doing it. We certainly have a decent effort there. Is approach of bringing equity approach, startup equity approach, which obviously was very popular in the last 40 years, into commodity space, right? So when you look at when you say, oh, I really don't like the fact that stuff is being correlated, but you can take advantage of this too, right? If you say, okay, well, there's nothing I can do about it, right? And obviously, if you have a group of correlated products, right, let's say WTI, Brent, diesel, and gasoline, well, maybe you can apply startup approach to it, right? And doing something like this actually provide completely different strategy to a commodity allocator.
Yeah, no, thanks. I guess talking about diversification and the way markets behave when you think you've got a diversified portfolio. We were talking before, Misha, about August 2007, and
yes.
I think that was a really interesting time.
No, of course, yeah. I'm sure a lot of people remember that, right? August 2007 was special for me from a variety of reasons. First, I was on the other side, right? Talking about liquidity provision, right? That's at that time, high frequency made money hand over fist just because the whole startup space was melting down, right? Now, why is the startup space was melting down? You had beautiful firms, right? Like their strategies with a lot of diversification from the point of view of risk. People use bar, ETFs, sector, whatever, like their own PCA. The variety of risk approaches that would make daily P&L returns completely different for many strategies. And yet, in second week of August or 7, everything went down. So what happened? Well, first of all, it started not even in startup, it started in credit space. Credit space, all of a sudden, right, like whatever, the spreads gap. People, multi-strat who were invested in credit, right, like needed cash for margin calls. Where do they take cash? They go to the most liquid securities they have, which was equity portfolios, and start liquidating them. When they start liquidating them, essentially for everyone who were participating in this space, they realized that their longs, their highest longs and highest shorts are correlated. So your highest longs go down because somebody is liquidated. Your lowest shorts go up, right? It got to the point where few Japanese startups, which have nothing to do with United States startup, nothing to do with United States credit or debacle in credit, got blown up because multi-strat who also have allocation to Japanese startup start deleveraging this portfolio. So to me, it was a lesson, the first lesson that no matter how good your risk system is in equity space, your biggest factor is really deleveraging. Unless your positions are so uncorrelated to positions of other people, right? Like unless your source of alpha is completely different, right? Or you have to position yourself such that you will take advantage of this deleveraging very quickly. So, and I don't know, Derek, I'm interested in you've probably seen this all happening, right? So how do you think about our risk or equities risk in particular?
So I do this at the manager level and I do it at my portfolio level, right? We tag every investment we make by their primary and secondary risk factors. And so my mandate, we put our $6 billion hedge fund portfolio on top of beta, right? So we don't want my portfolio to draw down, my portable alpha portfolio to draw down when the beta is drawing down, right? Or ideally. But in order to build a low beta portfolio, typically there are a couple of different ways that people like us build those portfolios, right? I try and buy the managed futures smile because using managed futures and other strategies, and that might, hopefully that works. A lot of our peers will either buy credit beta because it's lower volatility and has this kind of carry component, or relative value strategies, which are, fine in 80 to 90% of the distribution. But both of those strategies have conditional volatility when you least want it, right? So our primary, but I will say right now, our primary risk factor is not beta, it's deleveraging risk, and it's either credit risk or deleveraging risk. Credit risk because while we don't typically lean long, after March of last year, spreads are wide. We went after that. That was an opportunity that we thought we should go and capture, and that's been kind of coming down over time. The only other thing I would say is, from a diversification perspective, when we start looking at non-correlation over negative correlation in the portfolio, we start looking at things like insurance-linked security, like ILS, reinsurance, stuff like that. And that's had kind of mixed results. I think a lot of people thought that was going to be kind of a panacea for the portfolio. The other thing I see people do is so we were talking about diversification with high frequency trading. What about smoothing, right? What about, I see a lot of our peers buying things that mark quarterly or, quarterly in arrears, right? So yeah, I took the hit, but I'm going to see it 3 months from now. And hopefully my liquid portfolio comes up. Well, I think a lot of pensions are doing this at the asset allocation level while you're allocating more to private credit and private equity. It's when your liquid book draws down, your non-mark-to-market kind of stays up here. And then hopefully, your liquid book comes back, and when your mark-to-market or your non-mark-to-market book marks down. So we don't do much of that because we have liquidity needs. So I think you really need to be careful about, the things that you're there's no free lunch in this world. You need to do a little bit of all these things because you don't know what's going to be there when you need it. And you certainly, like you said, we think that anything's going to have a 50, hopefully a 60% chance of working when you need it. We don't buy a tail hedge because the expected value is negative to us. We haven't found enough convexity in the markets to that makes it worth to buy that insurance. So couple things there.
John, how do you deal with that sort of situation? The deleveraging problem?
Yeah, I just want to take a point that Derek said there just on the smoothing just a little bit further before coming back to that. And, something we even see in the liquid strategies, and it comes back to Misha's original point as well, is we all concentrate in as differentiation as this correlation metric, daily correlation between strategies. And even within liquid future strategies, depending on when you get your marks from your administrator, whether they're marked at the same time of day globally or whether they're marked based on the exchange closes, these things can even have quite large impacts on your correlation statistics. So the same thing that Derek's talking about in smoothing can also occur even with liquid strategies. And I think from our perspective, the way we try, and it sounds very similar to Derek, is we try to take a mosaic approach, right? Is that you can't just rely on one silver bullet, one panacea to metric your diversification in the portfolio. And I think, if you start to build up a profile of the key kind of metrics, different granularities, you can look at correlation under, and that's just one statistic. You can start to do other quantitative components to that, drawdown being another, the co-movement of drawdowns, all these things. We only have one path. We only have one existed history. So you have to take a little bit of salt sometimes with the quantitative side, and you have to add in the qualitative side as well, which I think we're talking quite a lot about here. Is what are the actual return drivers of these strategies? What is actually driving the strategy behind the scenes? They may seem like they're 0.6 correlated to each other, 0.5 correlated to each other. But when that underlying return stream starts to suffer, where will these strategies end up? And I think that's where we can, as a specialist, we focus in on trying to find these blind spots within our space. Where are these blind spots in the portfolio? I think, in general, from our perspective, it's not just that one point of view, not that one factor, deleveraging risk or whatever it has to be. It has to be that multi-phased approach. And one of the things we like to do is a bit like Derek again, is people see all these managers within the space as trend followers, and that's their categorized. They've categorized them as a trend follower. They've categorized them as short-term trader. We don't take that approach. We try and say, okay, 80% of their returns are probably driven by trend, but there are these 20% which will, co-move with carry factors or value factors, whatever they happen to be. And if you don't account for that, you can end up with some nasty surprises or maybe unexpected surprises within your portfolio, I think.
Yeah, so one of the questions that I was going to ask actually is whether you think trend following is a true hedge, and that sounds like you've answered that. So a couple of questions there. Trend following in alternative assets has become really popular as a concept. A lot of people are finding that they can achieve good returns from that. Is that a hedge, or is that sort of a blow up waiting to happen?
This is an interesting question, and the two extremes you've given me there, Diane, on that side. I suppose, our view, as I said, we do a lot. We allocate a lot to trend followers. We allocate to the space quite a lot. From our perspective, alternative markets, new markets, you have to go back to the premise of trend following. Trend following is predicated on lots of individual small bets, a small edge in each of them, and trying to maximize the diversification, use the leverage inherent in futures to try and generate a good risk-adjusted return at the end of the day, or a decent risk-adjusted return at the end of the day. And I think it would be from our perspective unusual if those managers weren't seeing where are the other opportunities out here, right? What are the other things we can add to a portfolio? So from our perspective, we have seen that grow and that remit grow, but it comes back to the underpinning that from our perspective, we expect our managers to be researching, to be pushing things forward. And this is kind of a logical extension. If you think about it, you can either change your systems or you can also change the markets that you trade. So, from our perspective, we see our managers as kind of active developers of their systems, developers of of kind of their overall program of work. And if they weren't looking at the opportunities that are there in some of the additional markets, I think, you'd have questions, in terms of where the research agenda is going. Are you asking questions? Are you pushing it forward? Are you looking at all the opportunities that are out there? In terms of kind of the hedge question, shall we say, Diane, on that side, I think that our view on trend following on managed futures is more akin to a diversifier to the portfolio. I think we've always felt that the word hedge is quite a strong one and implies something more than something which is very valuable to a portfolio, diversification. But a hedge to me is something stronger.
Yeah, I think they've always, what worries me is that they tend to be path dependent as well. They can be great, but Derek, do you use strategies that exploit alternative assets, and do you have a core allocation to trend?
We actually don't. We actually have zero allocation to trend. We about 2 years ago we transitioned I had a belief that for the last few years, you see these sharp spikes in the market and these vol spikes, these sharp sell-offs. So I went from having kind of a diversified trend following portfolio with a little long, a little intermediate, and a little short-term trend following, and call it what you will, crisis risk alpha. I saw you give up a little bit of sharp, but you pick up some crisis risk alpha. I was seeing in shorter-term trend, and so we kind of sold some of our longer and intermediate term and kind of moved our duration of our trend following a little bit shorter a couple of years ago. And then what I started noticing was that given what Fed policy is going on and what's happening with central bank policy around the world, is that these shocks are happening. Yes, you can look at the data and maybe capture some of that convexity, but I thought that humans might be able to actually capture some of this convexity a little bit better using nonlinear products, things like that. So we shifted our short-term, trend following capacity into discretionary macro with a little bit of a shorter-term time horizon and using a little bit more convex product as opposed to linear product. So that's how we kind of picked up that diversification. But we do, which I'm sure everyone else around here does. We have about 24, 25 line items in our portfolio. We run the covariance matrix and we actually look at what's the real diversification. We call it the effective number of bets in the portfolio. And usually for the last 5 or 7 years, the effective number of bets in the portfolio has been, 16, 17, and it's closer to like 12, 13 right now. And your event-driven managers are correlating to your macro traders, and your equity managers are leaning long, and so you're not getting as much diversification over the last 6 to 12 months. And maybe there's a reason why, because things were dislocated and you want to be long risk. But I think that's changing now, or it's going to change, over the next few months. So we are actively looking for new ways to insert diversification into the portfolio. Or conversely, we're taking risk down too, because we've just captured a huge spread compression. Now we're taking some chips off the table, and maybe we'll reload and allocate if another dislocation comes. Or do you need 5 long-short equity managers that are all kind of leaning in a similar direction when you can have 2 or 3? So that, we're doing a lot at the portfolio level right now to either force diversification, take down risk, or just know the risk that you take.
Yeah, really interesting. Amisha, you had much shorter end, so I don't know if trends come into the way you look at things, or you're looking at price movements, obviously, but
no, I think similar to what I said before. We are not focusing on price changes or returns. We are focusing on people's actions, right? Like that's the kind of revenue we went. And interestingly, by kind of our finding is that we are better in finding alphas in more liquid securities in that space because the pattern repeatability of people doing stuff is much more stronger, right? So our model tend to predict, let's say, ES future or S&P 500 mini better than it would predict cocoa, right? And once you go to timber or whatever, orange juice or milk or Indian spices, right? Like, so the idiosyncratic volatility there is, and I agree with both Derek and John's, much more akin to a discretionary trader who is like doing nothing all day long, but like reading something about Indian spices, right? And then look, if you want to diversify yourself with that, you're better off going into discretionary world. And I think one interesting question related to all of this in my mind is the scalability question, right? Because depending upon the size of the allocator, right? Like you have certain limitations in what you can do, right? So if you need to allocate like $300 billion, right? Like probably Indian spices would not do much to you, no matter how much somebody will tell you about alternative assets. It's just like there's no capacity. So then by definition, your focus kind of have to be determined by the practical constraint you have. And if practical constraint that you have to allocate this much money to beta, then the best diversification is to figure out when beta is right to be in versus like you pull out. So your best diversification is going in a long direction, risk on, risk off. And can you make this dynamic, right? Like will determine the performance of your portfolio much more than adding a little bit of like milk futures or with our timber or with our Indian spices futures. So I think scale is the key.
Yeah, it's a huge issue, isn't it? Because I mean, you also, managers that seem to be successful and take on more money, then you can see that returns suffer after that as well.
Yeah, you start with somebody who is doing like really, really great, like on 10 million in alternative futures. And then people say, oh my God, we need to diversify, right? Like, and the guy gets $1 billion and all of a sudden, like there's nothing, right? Like bleeds money because your trading costs are not zero.
It's interesting you mentioned that as well, because the big story at the moment in the futures world is Chinese futures, right? This concept of China opening up. And I see all these stories about the huge volumes they have, but small contract size. And maybe in some of these contracts aren't that volatile. So it's about how much risk can you get away given your size. So I think that's a nuance which is often missed. Volumes and open interest don't necessarily mean capacity or ability to deploy risk in that space.
Yeah, although John, it happened to be that some of the contracts right now are really big, right? Like you're talking about construction sector or chemical sector, right? Like they have grains and grains, metals, plastics, whatever. They're not that big, but construction, chemical, right? Like they starting to pick up some volume.
One of the questions,
one other kind of interesting thought is. And from the learn, so I'm hearing Misha say, when you have to allocate a bunch of money, like you can't get into some of these strategies, and so it's a big place, right? And we run a large hedge portfolio and other portfolios, and one of the strategies that did well last year were, you used to think that AUM was kind of the death knell of alpha. And then you see some very, very large platforms. You saw some platforms not do great last year. You saw some very large ones do incredibly well last year. So then they take in even more assets, and guys like us, like, yeah, I think there's another risk factor that people don't appreciate, and I call it platform risk factor, right? Because is it, I have, Janet Yellen over here on my desk because, she's done so much for us over the last year, but, and the central bank policy, but over the last few years, but I do think that there's, maybe these large platforms were saved in March last year, but you need to be very, very careful that I do think that the leverage used and if you're $40 billion and you got 200 pods, and there are 3 of those or 5 of those kind of groups around the world. Like it's illusory to think that they're doing something completely different from one another. And I do think there's another potential August of 2070 kind of thing that might happen. That's why I think deleveraging risk is a real thing, because like at some point those things are going to correlate, and they're going to need to sell. And you saw how quickly I was actually impressed with how quickly those big platforms delevered in March and April. It was actually fairly impressive, but they were also saved too. So what happens if they aren't? I think that could be a real eye opener for people going forward. So that's one of the things that in that list of what keeps you up at night, that platform risk, while it's been very beneficial to us and we own a good chunk of that risk, it is something that keeps us up at night.
One of the questions we've got is about what sort of strategies other than trend following do provide diversification, especially without a negative carry. We had discretionary macro as one of the favorite strategies on the poll, and Derek, you've mentioned discretionary macro as being sort of a key area. What do the panel think? I mean, are there other areas that sort of stand out, and how much can you have in discretionary macro? That too can get a bit crowded. I know it's perhaps not as correlated as systematic strategies on the surface, but these guys are all reading the same news and hearing the same things. So, potentially there is scope there as well.
And discretionary macro had a wide range of outcomes. If you were a front-end rates trader last year, then you did pretty well. But there are a lot of strategies that had a tough time too. So you need to. I think it's going to continue to come down to. There's no free lunch. There's no silver bullet. Like reinsurance had a tough year last year, and we do some financing trades. We just want orthogonal sources of risk as wherever we can find them, because we don't know what's going to work. We don't know what the shock event's going to be next time. So we just want to have really different. I want to get that effective number of bets number. I want to get that as high as possible. I want everything in the portfolio to have its role. Like John was saying, you understand the drivers of risk and return. You want them to be orthogonal to one another, and that's our job. And so that's what we try and do every day. And Misha does it at the alpha level.
We're coming up to the hour, but the one thing I wanted to ask you to all just mention or talk about is 2020. How did it work for you? What was really good? What was bad? And I suppose, how confident do you feel going forward that what you think is diversified is actually going to actually prove to be diversified? Misha, would you like to start?
I obviously, these guys will take on the strategic level, and I will start with my kind of like a tactical level. So 2020 was great for us. That in fact that it sort of validated the theory that like what we're looking at, and as I said, actions of people or supply demand imbalance on the short horizon is actually independent of what's going on the macro level, right? Like, so if you focus on the short-term supply demand imbalance, you do fine, and we meet our target. So we're very, very, very happy with that. So to some extent, it was kind of boring in a way, right? But a good boring, and we think that the world should continue that way. And the two things that we like really focused on is one is dynamic changes of covariance matrix, right? Dynamic changes of diagonal elements between like stocks and bonds or whatever, right? Like your dynamic changes of correlation worked really, really well, right? And focus on people's actions as opposed to prices, right? Like this supply demand imbalance worked really well. So we were happy. We think it's sort of should go forward the same way. And just to, I can't not mention the comment about discretionary macro, because we are very, very far from discretionary macro. We are not we quant through and through. And our motto, one of the motto we have is the quote from Agent Smith from Matrix, who said, "Don't send a human to do a machine's job." So we believe that like on certain levels, everything should work just as it should work, right? Like whatever happening on the outside, and as long as your horizon is short enough, it tends to be true.
Brilliant. John and Derek, you've got about 1 minute each. John, would you go first?
I'll try and be quick, Derek, to give you your opportunity. But I suppose my interesting takeaway from 2020 was some of the dispersion we saw. So from our perspective, again, concentrating on the managed future space, March, was the largest dispersion since October 2008. Maybe a similar enough market environment where we had, all assets selling off. We had treasuries, gold, some sort of hedges, for want of a better word, suffering as well. You had quite a liquidation event, maybe similar to October 2008. So, the heart of the financial crisis. But by the end of the year, dispersion was probably under average, right? Just under average. So to Derek's point earlier, there was a very sharp reversal, a very sharp path back. So my kind of takeaway from last year was to think about the counterfactual. What would have happened in another scenario if we hadn't had the Fed, or the Fed wasn't deemed to be effective, right, by the market, and we saw a continuation of said moves. And that counterfactual, that alternative history, we only have one path to it. So thinking about maybe, how effectively the platforms delevered, as Derek said earlier, how effective was that, and what happens if they can't quite get out of those positions? From our perspective, where were our managers positioned? When did they change? Those sort of things are kind of the key things, I think, to not fighting the last war always. That constant refrain we hear that generals fight the last war. It's true for investors to a certain extent as well. I think we're always looking at things playing out exactly as they did in the past. So from my perspective, it was, okay, we ended up in a nice place at the end of the year, where managers were generally up and positive and so on. But that path and what could have happened on that path was very informative, I think.
Yeah, thanks. And Derek, we've been told we can go a few minutes over, so you don't have to panic. But over to you.
No, I think I agree with everything that Misha and John were saying, right? Like I think we dodged a bullet last year with monetary policy. Like there was huge dispersion in manager returns, but generally speaking, by the end of the year, most, on average, all the sub strategies that we cover were positive on the year. And there are some great returns. I think, but I do think there's a little bit of beta. There's a lot of beta in there too. But going forward, I think you're going to get paid for security selection. I think you're going to get paid for. I do think there's going to be dispersion at the security, at the country, at the product, at the asset class level. I think you're going to get regional diversification. I think Europe's going to come out of this thing, slower than the U.S. and Asia's already come out of it. And it looks like growth is actually slowing down a little bit. So I do think you're going to get opportunities to force diversification into your portfolio. And I'm cautiously optimistic. Hopefully the VIX, I almost cried when the VIX went below 20, but now it's whatever it is, 17. I do think you're going to get moderate bouts of volatility. I think you're going to get paid. I do think there are differing opinions in the world. So you're getting two-sided markets, and that's kind of fun. These are the environments I really enjoy, actually, because you get to get paid for doing your homework, and so these are the fun times in my view.
Well, thank you very much, all. I think we've gone over our time slot. I apologize to anyone who's asked questions that haven't been answered. I'm afraid we're too busy. Everyone's got too much to say to get through all the questions. But thank you very much. And it's been a really interesting discussion. And let's look forward to the next one. Great, thank you.
Thank you for having
me.
Thank you, everyone. Oh my God, it's the search for the Holy Grail. I mean, it just continues. And I love, Derek, you ending on such a hopeful, really a positive note that this is the exciting stuff. As the pandemic, we feels like we're rounding the corner. There are people predicting, just a thriving economy. It's going to be fun, and we'll keep talking about it. So thank you so much. That was really enlightening and a lot of food for thought for our audience. Thank you, everyone, for participating and for being on the horn here with us. I hope you enjoyed it and have a terrific weekend.
Yeah, good weekend all. And thanks very much, Meg, for setting this up.
Thanks all.
Bye.